All right, my good people, episode 4 is here, baby. Episode 4. What are we talking about today? We're talking about the stock market. One of my favorite topics, the stock market. Let's go! All right, so before we get started, quick recap, all right? If you haven't already, go back and watch each of the previous videos in a row. There are 3 of them. Please go back and watch them in a row. There's method to the madness, right? There's a purpose behind doing these steps in a row, right? Knowing your numbers, budgeting, knowing about inflation. These things are very important. Before you start investing, you have to have a solid foundation, right? And that starts with the previous video. So go back and watch them, right? Please go do so. And without further ado, let's get into the stock market. So people ask, what is the stock market, right? Is it only for rich people? No. All right. What is the stock market? Let's take all the fancy stuff out of it. All the stock market is a bunch of businesses around the United States and around the world. That's it. The stock market is a place where you can go to purchase shares to become part owners of those companies via investing, right? In turn for giving them your money, you're given shares, and as those shares rise in value, you become more wealthy. That's it. That's all it is. That's all the stock market is, right? You have the Dow Jones Industrial, which tracks about 30 of the biggest companies like Coca-Cola, Nike, Microsoft, Johnson & Johnson, really big companies. The Dow Jones Industrial Average tracks 30 of them. The S&P 500 tracks about 500 of the biggest companies. Most people think the S&P 500 is a little more is a better metric because it tracks more businesses than the Dow Jones. But either way, all that doesn't matter. All it is it tracks how well companies are doing across the United States. That's it. And the stock market is a place where you go to purchase shares to become owners of it. That is it. That is all the stock market is, right? So let's think about the stock market in terms of it being a shopping mall. Say one of the biggest shopping malls in the world. Say you got, 3,000 stores. Right? What we're going to talk about now in terms of the stock market is an individual stock, right? A mutual fund and an index fund, right? So this is what we're going to talk about for the next few minutes, right? So imagine an individual stock being one store inside of the mall. Think about a mutual fund, right? Think about it being several, maybe 30 or 40 or 50 different stores in one mutual fund. Or think about an index fund, pretty much a little bit of every single store inside of the mall. So index fund, every single store inside of the mall. Mutual fund, maybe 50, 60 of them, right? And an individual stock is one actual store in the mall. This is our frame of reference for sort of thinking about how we want to attack this, right? So an important thing to know when you're investing is you want to be diversified because, yes, you are risking your money. You're giving your money to a business to do something with it. If the business doesn't do well and go under, you lost your money. That's basically it in a nutshell. So you want to be diversified. You hear diversify your portfolio, all this stuff. All that means is you want to have several different stores, 7 different companies in your portfolio in case one of them doesn't do too well. You don't lose all your money and you're protected a little bit. So an individual stock, one, is no diversification. A mutual fund is pretty good diversification, right? Because you got 30 or 40 stores. And an index fund is pretty much very, very, very well diversified. So if something happens to Nike, say one store, something happens to Nike, they go down, you lose all your money, right? Let's say you have Nike, but it's inside of a mutual fund with 30 or 40 other stores, right? A nice mutual fund. If Nike doesn't do too well this year, right? And say you have another store, Banana Republic or Gap or something, and they do very well, right? It can balance it out, right? So that you don't lose all your money, you could do very well or what have you. So you want to be diversified so that it brings down risk of losing your money. That's all it is. So diversification, index fund, mutual fund, individual stock, okay? And you can Google these terms on your own for more reading. I don't have time to do all of it, but that's just the Cliff Notes. Do kids even talk about Cliff Notes now? I don't know. Doesn't matter. So That's the basis, right? That's all the stock market is that. Okay. Now, what do people say when you want your money to work for you, right? Right. If you're sleeping in bed at night and your money is invested, there's a lot of smart people running these companies, right? A lot of smart people went to the Wharton School of Business, all of this stuff. They're running these companies. They know what they're doing. So they're doing well for a reason. So me, myself, I'm going to trust these people to do what they do. So you know what? I'm going to give you my money. I've seen the history. I know how it's performed. So I know you're going to do well, right? So here's my money. I'm going to go to sleep. When I wake up the next morning, it's probably going to be a little bit more valuable than it was the night before. And that is what has happened throughout the history of the stock market, okay? Let's talk about the history of the stock market, right? Because people ask this question, well, is it risky? Am I going to lose all of my money? Of course, there's a risk of losing your money. But in the history of the stock market, every single time there has been a crash, there has been a recovery. Every single time there has been a crash, there is a recovery. For example, let's think about 2020. Think about what happened in about March of this year. COVID happened. Everybody got afraid. Oh, take the money out of the stock market. Yeah, the stock market went down. It is now November, and it is back where it was and then some. So let's talk about this for a second. The only way you lose your money is in a stock market downturn is if you take the money out. So for example, back in March when the market crashed because of COVID, if you left, say your money was in Facebook or something, whatever, doesn't matter. Say your money was in that. When the stock market crashed and it went down, the value of it went down, but you held on to your shares, which means you did not lose your money. The people who took their money out when the market crashed, they lost their money. If you would have left your money in when it happened and bought more, like me and many people did around this world, they are doing much better today than they were even in February before the crash happened. All right. So this is important. In the history of the world of the stock market, every time there has been a crash, there has been a recovery. Think the Great Depression, which was very bad, lasted a very long time. Think about the Great Recession of 2008, right? Pretty bad, the housing crisis, right? Think about COVID and what have you. Every time it went down, it came back up. So I would actually argue it is one of the safest places to have your money. And another reason why I say it's one of the safest places to have your money is this. Where do you think the politicians and the most wealthy people in the world and in the country have their money? Do you think it's sitting in a bank? You think it's sitting in a safe? No, it's in the stock market because they understand inflation and they understand the history of the world. So if for no other reason, wouldn't you want to do with your money what the most wealthy people are doing with their money and the politicians who write legislation to protect the stock market when it goes down? Why? Because their money is in it. So I would argue it is one of the safest places for your money to be. And again, if you know about inflation, if your money is sitting in a bank account, it's only earning 1/2 of a penny every month, right? Inflation is stealing from you. Remember that? So I would argue it's one of the safest places to have your money, period. All right. Let's talk some numbers. Let's talk since the crash of 2008. I'm going to give you a percentage of how in terms of performance, how the stock market did every single year since 2008. This is an index fund, S&P 500 as a whole. So, 26%, 15%, 2%, 16%, 32%, 1%, 12%, 21%. The only year where it went down was in 2018. It went down by 4.3%. But 2019, it went back up 31%. And 2020 thus far, about 12%. So that's an average of 15%. Look it up if you don't trust me. All right. So again, yes, it's risky, right? Yes, but I'm going to put my money where those people that I mentioned before have their money. All right. That's what I'm going to do. And I mentioned, right? If it goes down, don't sell. The only way that's a little bit different is if you're very, very close to retirement. We're going to have a separate talk on that in the future. So in a nutshell, that is the stock market, right? What it is, being diversified, okay? Is it risky? Yes, right? But it's still the best bet, and it will be the best bet in the history of man, okay? And I gave you the performance of how the S&P 500 performed, the 500 biggest companies, how they performed over the past 10 years roughly. They grew by 15%. So again, it's a very, in my opinion, it's a very safe place to have your money. You would be unwise to not have it there. So again, this is what the stock market is, okay? So for homework, your homework is you're going to look up 3 or 4 random companies. You're going to track how those companies perform, let's say for about a week or so. Again, I know this is a small snapshot, but we're going to look at Disney. We're going to look at Johnson & Johnson. We're going to look at Nike. And let's look at the Coca-Cola company, okay? Google those numbers. Find out what their ticker symbol is. That's the only thing that means is that's the symbol that they use to look up their stock. Google ticker symbol for those 4 companies. Look at how they perform. And we're going to have some follow-ups to this as we go forward. Next week's conversation or next video's conversation is compounding interest. And we're going to go over it in depth. All right? So, as I mentioned before, the game is free. But the discipline is sold separately. Let's go!